How's it going, guys? Just gonna keep it really simple. Um, ICT is basically a trading strategy. It just requires things that are called sweep outs. And what they do is that they'll sweep out these orders so that they take out the stop losses and such, so that they can move in the opposite direction. And that's usually how like the ICT concepts work, or just in general like the whole market structure shift idea. But I was studying quite a bit over the past like week and a half of like the concepts and why it exactly works the way that it does and why people follow it so often. And I'm gonna provide some clarity to how I basically became better just because of it. So what it is that it really depends on larger time frame. And what you do is that you look at the larger time frame to identify areas of opportunity on where the people or the institutions are trying to sweep out the orders. And then you basically wait for the trade to come in your direction. And then once it gets into your direction, you take the entry. And then that's like the basis of, it's like the foundation of the whole thing, right? It goes from larger time frame to smaller time frame. So what I do is that I look at the weekly chart, right, to identify what the state of the market is in, right? Right now, we had last week close above this prior sweep out, which indicates that buyers are actually holding it above the price. So right now, market structure does look a little bit more bullish for me to consider taking longs. Number two, the daily sometimes I ignore because the daily doesn't really have that much representations on each of the days. Like it doesn't really work out the way that I see it. But it does work out on the weekly, it works out on the 4 hour, and it works out on the 15 minutes specifically. The 1 hour can happen sometimes, but it's kind of rare. I noticed that the 4 hour makes me feel a lot better to take a trade knowing the direction is going to break out. And then I aim for specific liquidity areas. So just to make it easier for now, I'm going to look at the 15-minute chart because that's what I typically use. I use the weekly, I use the 4 hour, and I use the 15-minute. The 15-minute is very helpful in this instance. So looking at the overall trend, we can see that the market has sold off at the beginning and then eventually started making higher highs and higher lows, and then eventually broke out to the upside just right over here. Now, how to identify the market is going lower, and also how to identify that the market is going higher? I'm just going to basically identify first how the market is going higher. And then you'll be able to gather some data on why the market goes lower. Because right now, the short side, I don't really understand. I know more of the long side. So what I do is that I measure out the inefficiencies from the high using a Fibonacci tool, right? The Fibonacci tool from the high all the way to the low, right? So right now, let's say for example, the market has gone to this low and then eventually turned around, right? And then it broke the prior high, which indicates that the market could be changing structure. What I do is that I'll wait as long as I can for that opportunity to come, right? And when the opportunity comes and I notice that it starts changing in structure, I want to start measuring out basically the areas where they break out each time, right? So in this instance, we have the high created, we have the 50% mark created, and we have the low created, right? And on top of that, with confluence, the 4 hour on October 10th has been swept. So that indicates that all the stop losses that longs have gotten in here are now officially stopped out. So this right now is considered as a liquidity creation for the market to basically reverse, and there's a high probability that the market will continue in the direction that it's going, right? So that's how I utilize the 4 hour. Plus on the weekly, we do have a fair value gap that's right here that got swept, and then on top of that, we have the prior high from August that got tapped, right? So as you know, higher highs, higher lows, higher highs, higher lows, higher highs, higher low still. This is just a swing low, but it's not broken this specific low for us to consider this market being bearish yet, especially on this weekly. It shows that it's much more bullish. So this indicates that this could have been a trap for short sellers, right? So now I have those three instances in my mind as I'm looking for an opportunity for longs, right? That's how you understand market structure. So I'm going to get rid of this. I'll get rid of this and this. Now that I've identified the high to the low, and now we know that the market is continuously breaking higher, as you can see, the market broke above this prior high, right? We saw that the market broke above this prior high, right? Because just over here, you can see, right? The market comes up, breaks. This is the first move. On the second move, we break out, right? And then we also break out this prior high too. So market right now seems a little bit more bullish than we're expecting, right? So that's how I identify possibilities for us to take long when the market pulls back. Now, in this instance, this right here would be considered as a thing called the change in state of deliverance. Change in state of deliverance. Basically, on a short-term 15-minute candle, on our prior high, we have broken out, and we also have broken out this specific area. This is also considered as a change in state of deliverance, but just to simplify it, I'm going to use whatever is the most current value, not the consolidation, but more of like the pivot, right? And this right here, this high that got broken out, is a change in state of deliverance. So we call it the SysD. When the change in state of deliverance has been respected, and we break above it and we close above it, it generally indicates that the market will pull back eventually down the road, and we're going to be looking for an opportunity to go long again. So in this part, we are now understanding that this could potentially be the protected low. Protected low, right? So this right here is a protected low because 1, 4-hour has been swept, 2, the weekly has gone into the fair value gap, so that's 2 confluences, and 3, 15-minute has broken out. So right now, this right here is considered as a protected low until further notice, right? So our goal is to find an entry opportunity from this range to this high, right? Anything below this specific 50% range, right? So right now, let's say, for example, the market is moving higher and higher, and we haven't identified a pullback yet, right? Let's say the market looked like it was about to break out, and it could continue higher. What we'll do is that we'll actually just wait. We'll wait until it starts turning around and basically start selling off aggressively below the 50% for us to consider taking longs for a higher probability trade. So that's the depth of that analysis, right? Generally, in some of the ICT concepts, we would actually utilize the most higher low here for us to basically find the pullback below the 50% and then take longs here. But in this instance, it's really based on like the probability. You want to look at the protected low. What is the lowest value that you can see? And we can use that as like the first initial area where they pivoted, right? Like, you know, the market was selling off for almost 2 weeks. There is obviously going to be an area of opportunity where they could potentially even do a double sweep out before they go higher. So that is always a possibility, right? It's not guaranteed, but it does mean that there's a possibility. So in this instance, we have that pullback right here on the 15-minute. In some level, in some key frames, we'd be able to look for a long here, right? In some trade plans, whatever, we'd be able to look for a long here and basically aim for the most recent left-hand side area of a pivot, right? For another breakout, right? In the liquidity area. So in this instance, 293 points and 50 for 138 in risk, right? But because that risk is so much, generally I would not be comfortable taking that. My most amount of risk that I'd be looking for in each of my trades is probably going to be less than that, maybe about $500. So this is not really a good ideal candidate for a trade. So you have to really learn how to identify whether the swing is too big or not, like, you know, big enough and such. So in this instance, the risk is very big. So I would probably not even hold on to this trade or do it, right? Based on that based on that factor, sorry. All right, so then the market eventually sweeps out this prior low, and that the protected low doesn't get swept out. So this right here is an opportunity where we can look at a lower time frame chart and see if there's an opportunity for us to jump in longs, aiming for the internal high, right? The internal range high, which is going to be either down here. There's going to be probably like a fair value gap, and you would aim for 300 points, and your risk would be about 70 points. So that's a good risk to reward, right? Eventually down the road, depending on like each instance, you don't have to take every single trade. You always want to wait and find the trade that fits all your criteria for you to take long, right? In this instance, this does fit a lot of my criteria, so I would wait for the opportunity and probably end up taking long somewhere down here or even in here, right? For a scalp, I don't know what it's going to be, but it does seem like right over here where the wick pulled upside, it looks like it did dip first, and then it went all the way back up, and then it closed red. So that was actually potentially a 50% move right there within the range, taking out the prior high and then eventually closing red. We can just double check with that actually. Yeah, so in this instant, 5 minute, we actually ended up doing exactly what I said. We went above the range right here. We had eventually the selling pattern. We came into the 50%, right? We came into the fair value gap, and then it bounced all the way up and then fulfilled the trade. So this trade would have actually worked out going for the internal side liquidity instead of going anywhere else. But the risk is very big. So I'm not really sure. So this was a little bit of a grain of salt, right, for a type of trade. Now in our other instance, because this high was closed out and we actually pulled back very strong, we can actually either one, look for an opportunity of longs within this low of a range. In this instance, right, this right here would be considered as the SISD, change in state of deliverance. If this right here ends up breaking and closing above the range, we could probably take a long here because they swept out, and this would be a high probability trade aiming for the internal range right over here. Either 100% of the move or 50% of the move, which is just right here at 105, and then eventually pulls back into a breakout lower if that ever came. But in this instance, it never came. So on the 15-minute, you would look at this and then eventually measure that out, and it would not work out, and you would probably get stopped out. So now the next trade after that, we break out again, right? Which means that right here is the change in state of deliverance, this high, change in state of deliverance, right? This prior high right here is a change in state of deliverance, right? And then this right here is the official high, right? We broke out of the range, which gives us an opportunity for basically longs again, right? And we've now broken completely, right? We are now aiming for either this area to take out our liquidity or even up here at the 50%. Right, the market will eventually pull back, right? So we now aim for the most recent low that caused this move up, and we measure from the low all the way to the high, right? And then on the lower time frame, we'll look for a pullback into this lower 50% bracket where we can take longs for a safer type of trade. So for example, here you can actually take it down here, and then basically our stop loss would be the low of this candle, or even down here, and then the low of this candle. This is the protected low. This technically should be the protected low now because we've broken out, and the market should not retrace back into that. In this instance, we bounced off the prior high SISD, and then eventually we weren't able to find an opportunity for longs again, because you want to aim for longs within the 50% level. You don't want to aim for longs early because you might get caught, right? So this is like a really important factor. In the instance of the 4 hour, we did have a lot stronger buyers, and we actually ended up recovering. So maybe that's why the market is a little bit more bullish at the moment. But let's say the market kind of slowed down over time. It's going to have more of a stronger pullback to get more liquidity. And that's what we do. So we'll also switch over to the lower time frame in this instance too, to identify that area of liquidity, which this ends up being right here. So in most scenarios, it should actually pull back to this 5 minute. It should take out this 5 minute liquidity, and basically our long position should be just right here, with our stop just being here at 27.50 and then risking for the move at the highs. So that's going to be like almost a 1 to 10 type of trade. But in this scenario, it doesn't happen again. Now on the next trade, we break out, do the same thing, change in state of deliverance, right? So change in state of deliverance, we closed above the range. We closed above the previous high, just right here. So it indicates that the market is continuing higher. And now we measure basically the next pivot point where the selling happens, from here up to the high. And we look for the opportunities for the market to pull back into the change in state of deliverance, as well as this fair value gap just right here. So right here is a perfect opportunity, fair value gap. You jump in longs, you basically risk just to the low of this candle. It should not break below because this right here is a confirmation of a fair value gap plus an order block. So this should be a very strong move to the opposite direction towards this high, right? And the overnight market basically prevails and shows us a swing for that move of 303 points. So that's how you identify these 50% pullbacks. You want to look for opportunities in 50% pullback with the best risk reward scenarios in your mind, aiming for the external liquidity for the buy side, right? In this instance right over here on the left hand side, right, if we were to look at yesterday's move, right, we could go from this high to this low, right? And basically you're going to be looking for a the most recent high internal liquidity is actually here. You aim for the low, right? And then basically this right here is the 50% that we would look for longs if it were to pull back there. But over here, internal range again, we look at the high, we look at the low, and then we wait for the pullback to happen, right? So this right here is the external. Let's say, for example, we were to ignore this big move here. We will look at the external, right? We will look at the external, right? Because the consolidation is wide here, but then the consolidation within the range was internal, right? So we will now look at the external highs and lows and the 50% mark, and you can see that it pulls back into the 50%, and then eventually we take longs back up to this prior high and taking out this area of interest. Eventually the market pulls back really strong, fills out this gap right here, taking out the liquidity of buyers in the first half of the market, right? And then start accumulating. This is where an area of opportunity would be, where you take longs, right? And you're risking the low of this candle right here. For 55 points, we should be breaking higher towards the internal liquidity first, and then eventually external, and then eventually external, right? So it's possible that today we have a 931 point move, which would be crazy, but yeah, that's how I identify the 15-minute change in state of delivery, as well as the liquidity sweeps, and also how to identify if the market's going higher or not, and also looking for perfect opportunities for entering long. And thanks for watching. Bye.